Is now Mike Pyle. He's deputy head of the portfolio management group. Mike, great to see you.
Great to be here.
Does it matter, or is the earnings picture so good that it almost doesn't matter if the Fed tweaks by 25 here or there?
Listen, I think that stock prices are obviously both a function of earnings, which are historic, particularly some of the sectors that outperform today. But I think we are very focused still on the interest rate curve, particularly at the long end. We've seen, I think part of the reason why stocks were so strongly performing today is precisely because we saw some of those interest rates come down. Easier financial conditions, future cash flows discounted back to the present at a lower rate. The fundamentals are very much still matter, even as we kind of very squarely have our eyes on those earnings.
I was mentioning earlier, as much as 465 on the 10-year feels because of, where we've been in the last few years on the high end, how much lower would we expect yields to be given, nominal GDP growth, 5-6%, and all of the demand on the capital markets for new borrowing?
Well, I think you hit it right on the head there. I think one thing we are very closely monitoring is exactly that, the demands on capital markets. Obviously, historic CapEx demand around capital markets, just as obviously the scale of fiscal demands being placed on capital markets, not just from the United States, but really developed economy governments around the world, to say nothing of just, the basic run-of-the-mill demands from investment-grade issuers, from households, from the mortgage market, et cetera. All of that adds up to us to an environment where the risks are tilted upward on interest rates precisely because the capacity of capital markets are kind of out the outer bounds.
So then that goes back to my first question. In terms of interest rates, do you then dial back your expectations for stocks, or do you see that stocks have some sort of a cap on them because interest rates are just we're in a higher for longer kind of regime?
Yeah, I think it's exactly as we were talking about. It's that race between earnings and interest rates. We do see pressure upward on interest rates, particularly at the longer end of the curve. But at the same time, we don't see any slowdown of this, incredible CapEx wave that looks to us as if this is an environment that's still underbuilt, not overbuilt. We haven't seen in earnings this month anything by way of a deterioration of those CapEx expectations of what's flowing through there. And so to our eyes, the ingredients for ongoing earnings strength remain. And the thing we're just going to be observing is that, again, that kind of race between earnings and rates.
And it's understandable then that, equity investors are so fixated on the areas where there's scarcity, where you have these bottlenecks, where there is pricing, where we have quarters worth of visibility on insatiable demand. I guess the call has to be after that is that going to create a productivity payoff? Are we going to then get into a disinflationary spot?
That's exactly right. The way we think about it is, again, to kind of put it in race terms, the race between scarcity and abundance. That, right now, so many features of the economy are described by scarcity, whether it's energy markets, we were talking a moment ago, these bottlenecks around AI CapEx, capital markets. Ultimately, the payoff has to come from enhanced productivity and steps into a world where those scarcity constraints relax and we see greater abundance. That's a world where I think you can get the type of picture of lowering interest rates, stronger earnings led by productivity, and a very positive equity environment. But we've got, some steps to get from here to there. And in the meantime, it's that kind of race dynamic as we were talking about.
But that handoff period, if it takes longer than expected, then what? Investors will be patient.
Yeah, and again, I think that the challenge is that the crystal ball is especially hazy, I think, with respect to the historic, dimensions of what we're seeing go on. We pay very close attention to the data month in, month out. I think you can see fragments of evidence of productivity increasing, of some of these types of technology advances that we're hoping to see feed through. But I think the evidence is just that fragmentary at this stage, and it's going to take more to get confidence that that's really coming through.
Mike, thanks. Mike Pyle of BlackRock.